Warren, again, for people who are just waking up, they're tuning in and they want to know what you think about this sell-off this morning. To see the Dow down 700, 800 points in the morning, what's your reaction when you see something like that?
Well, my reaction is that I like to buy stocks, so I don't wish ill on anybody else, but I like if they want to sell them to me cheaper, I prefer it. So if that's roughly a 3% decline or thereabouts. I don't know how many 3% declines I've had in my lifetime, but there have been a lot of them. And I can't think of one that you shouldn't have bought on. Basically, that doesn't mean stocks are going to go up or down next week or next month or next year. But if there's something, if you like to own American businesses, you're getting a chance to buy it 3% cheaper. I don't consider that a lot cheaper. I mean, but how can it be bad news unless you have to sell stocks? Now, if you have to sell them for some reason, you're worse off.
The man you just saw is Warren Buffett, one of the greatest investors of all time. At over 90 years old, Buffett has successfully navigated multiple stock market crashes, recessions, and financial crises. Despite all of this, shares of his company, Berkshire Hathaway, have delivered an impressive compound annual return of around 20% annually, nearly double the compound annual return of the S&P 500. Over the past 60 years, Berkshire's stock price has surged by an astounding 5 million%, building Warren Buffett's net worth to over $100 billion. Notably, Berkshire Hathaway has historically outperformed the S&P 500 during most of the recent market downturns, demonstrating Buffett's ability to thrive in volatile market conditions. Now, over the past 2 months, the stock market has experienced significant declines. The Fear and Greed Index currently indicates extreme fear, signaling widespread investor panic, with some stocks having plummeted over 50% from their all-time highs during the recent sell-off. In this video, we'll break down some of Warren Buffett's core investing principles and see how we can apply them to our portfolios in the current market environment. So let's dive in.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
One of the biggest mistakes investors make, according to Buffett, is panic selling quality businesses just because their stock prices are declining. It's important to remember that behind every stock is an actual business. In the short term, stock prices fluctuate due to market sentiment, fear, and speculation, often becoming disconnected from a company's intrinsic value. The underlying fundamentals, like revenue, profitability, and cash flow growth, drive a company's intrinsic value, and it's this intrinsic value that tends to drive a company's stock price in the long run. Buffett often uses the analogy of owning a house. If someone offered you a price below the market value of your house, you likely wouldn't rush to sell it. Yet many investors sell stocks simply because the quoted market price has dropped. Conversely, if you were in the market to buy a house and found one at a deep discount, you'd likely see it as an opportunity to buy at a bargain. The same principle should apply to investing. Yet when stocks go on sale, investors often hesitate to buy out of fear. Buffett advises long-term investors to adopt the business owner mindset, buy shares in exceptional companies, and hold them as if the stock market were going to be closed for the next 5 to 10 years. Instead of fearing falling prices, Buffett sees them as opportunities to accumulate shares of great businesses at discount valuations. Which brings us to our next lesson.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life, you would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Buffett has a famous quote, "Be fearful when others are greedy and greedy when others are fearful." Right now, the Fear and Greed Index is showing there's extreme fear in the stock market, with the S&P 500 at one point in this recent market downturn having dropped over 10% from its all-time highs. Now, a drop of 10% is not uncommon. It's the 30, 40, and even 50% crashes that are more rare and create massive buying opportunities. That being said, a 10% drop can still be a good buying opportunity. It makes the market overall cheaper and more attractive to invest in. There are also individual companies within the market that have crashed more than the overall market, and these can present even better buying opportunities. Two examples that come to mind over the last 5 years are Meta and Netflix. Meta's stock price crashed by over 70% in 2022, partly due to a temporary decline in advertising revenue. Since then, advertising revenue has increased and the stock has gone up by over 500% from its all-time lows. Looking at Netflix, its stock price also crashed by over 70% in 2022 due to a drop in subscriber levels. Since then, subscriber levels have increased and the stock price has gone up by around 400% from its all-time lows. Applying the advice from Warren Buffett, if you make large investments in the right companies at the right time, you can make outsized returns in the long run. On the other hand, making impulsive decisions driven by fear or greed can lead to underperformance and realized losses. So what does Buffett consider to be a good investment to buy?
Just look around for things that are cheap. And that I was taught that, say, in 1949 or 50, it made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this, on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing. You got the machinery for nothing. You got the inventory and receivables at a discount. It was cheap. So I bought it. And 20 years later, I was still running a lousy business. And that money did not compound. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake. So you might say I learned something out of that mistake, and I would have been way better off taking what I did with Berkshire is I kept buying better businesses. I started an insurance business, Seas Candy, the Buffalo, all kinds of things. I would have been way better doing that with a brand new little entity that I'd set up rather than using Berkshire as the platform. Now I've had a lot of fun out of it. I mean, everything in life seems to turn out for the better, so I don't have any complaints about that, but it was a dumb thing to do.
Not every stock that appears cheap is a great investment. Buffett has learned this lesson firsthand. Early in his career, Buffett focused on buying deeply undervalued companies, often referred to as cigar butt investments, businesses with short-lived potential that were trading at rock-bottom prices. However, the strategy had a major flaw. It relied on a hope that stock prices would recover rather than long-term strength in the underlying business. Today, Buffett prioritizes quality over deep discounts. His investment philosophy focuses on acquiring exceptional businesses at reasonable prices, then holding them for years as their earnings and cash flows compound. During a market crash, many stocks will decline, but only a select few will represent long-term value. Investors should focus on companies with strong fundamentals, competitive advantages, and strong sustainable growth prospects, as these are companies that are more likely to compound returns. Simply buying a stock because it's trading at a lower price to earnings multiple than its peers does not guarantee higher returns long-term. Instead, compounding growth is what creates massive wealth over time.
We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. So when stocks are down, we're going to be buying on balance. And who wouldn't rather buy it, at a lower price at a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers, and that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. But they have that feeling that they just feel better when stocks are going up.
To summarize the advice from Warren Buffett, you want to avoid panic selling great businesses. Stock price declines do not necessarily reflect poor performance in the business, and selling out of fear can lock in losses unnecessarily. Focus on high-quality companies rather than buying average businesses at cheap prices. Exceptional companies with strong fundamentals will compound your returns faster over time. And finally, market crashes can create massive buying opportunities. Instead of fearing a downturn, analyze businesses separately from price action and take advantage of mispricings in the market. That's it for this video. I hope these insights help you make more informed investment decisions in this market downturn. Let me know in the comments section below which stocks you've been buying recently. If you found this video helpful, hit the like button and subscribe for more stock investing news and insights. Thanks for watching. I'll see you in the next video.